What provincial payroll taxes apply? Provincial payroll taxes are the extra layer that many US employers do not see coming when they first hire in Canada. You quickly learn about federal income tax, CPP, and EI, but some provinces add their own employer payroll levies on top of those. On top of that, every province has workers' compensation premiums that operate as a payroll-linked cost even if they are not technically called a tax. Understanding this landscape helps you avoid underestimating the true cost of a Canadian hire. Employee income tax withholding versus employer payroll taxes. The first distinction is between amounts you withhold from employees and taxes you pay as an employer. Provincial income tax is withheld from the employee's pay along with federal tax. You are collecting that on the government's behalf, not bearing it yourself. Employer payroll taxes, by contrast, are costs you pay on top of salary, similar to the employer portion of CPP and EI. When people talk about provincial payroll taxes, they usually mean these employer-side levies and premiums. Health and payroll levies in certain provinces. Several provinces impose health or education-related payroll levies on employers once their payroll in that province exceeds certain thresholds. The details vary widely. The common pattern is that smaller employers either pay nothing or a reduced rate, while larger employers pay a percentage of their provincial payroll. When you model costs, this effectively raises the price of labor in that province. If you ignore these levies, your budget for salaries may look fine on paper while your actual cash outflow is higher. Workers' compensation as a payroll-based cost. Every province has its own workers' compensation board, and most employers must register and pay premiums. Those premiums are often calculated as a rate per $100 of payroll, adjusted for your industry risk and claims history. While not labeled as a tax, workers' compensation behaves like one in your cost structure. Salaries go up and so do premiums. For a foreign employer, forgetting about workers' compensation is one of the quickest ways to underestimate Canadian payroll costs. Quebec and other special cases. Quebec has its own set of payroll contributions layered on top of federal obligations. These can fund provincial parental and other insurance programs. The exact mix of contributions differs from the rest of Canada, reinforcing the idea that each province is its own jurisdiction. If you hire in Quebec while using cost assumptions built on Ontario or British Columbia, your employer-side payroll bill will not match your expectations. Thresholds and multi-province operations. Many provincial payroll taxes kick in only once your payroll in that province crosses a threshold. That means your first hire may not trigger the levy, but your 5th or 10th might. When you operate in more than one province, each province looks at your payroll in that province separately. You could be under the threshold in one province and above it in another. Planning hires purely on a national payroll total will not help you predict where these levies apply. Interaction with CPP, EI, and federal costs. Employer payroll taxes are layered on top of CPP and EI, not instead of them. For each employee, you are already paying your share of CPP or QPP and EI premiums. Provincial payroll levies and workers' compensation premiums then add further percentages. When you compare the cost of a Canadian employee to a US one, you need to combine salary, employer CPP or QPP, EI, provincial payroll levies, workers' compensation, and benefits. Leaving out any one of these distorts the picture. Budgeting and pricing implications. If you are selling into the Canadian market, these extra payroll costs may indirectly influence your pricing. Labor-heavy services delivered by staff in provinces with higher payroll levies or workers' compensation rates will naturally be more expensive to deliver. Understanding that structure early helps you decide where to locate certain roles and how to set prices that cover your true costs without surprises. Compliance and registration. Where provincial payroll taxes apply, you usually need to register specifically for those programs. It is not enough to have a federal payroll account. Some levies are tied to provincial finance departments, others to specialized agencies. Workers' compensation boards are separate again. A clean setup means you know which provincial accounts you hold, what each is for, and when returns and payments are due. Mixing them together in your mind is a recipe for missed deadlines. Final thoughts. Provincial payroll taxes in Canada are not a single line item. They are a mix of employer-only levies and workers' compensation premiums that vary by province and by payroll size. For a U.S. employer, the safest approach is to assume that federal costs are only part of the story and to map out the full provincial picture before you decide where and how to hire. Once you know which levies apply, you can build them into your budgets and avoid ugly surprises a year or two down the road. If you want a simple way to compare estimated payroll add-ons from province to province when planning your Canadian expansion, you can explore more tools at www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.